every one of you to, I am very much delighted to welcome every one of you to this live webinar by the Institute of Directors Nigeria on the Directors Prospects for 2022. What will change and what should you do as directors? And I'm sure you'd agree with me that as directors, as business leaders, as policy and regulatory makers, and as professionals, there can't be a more apt topic at this point in time, given the passage into law of the 2022 appropriation bill. It was actually signed into law on the 31st of December, 2021. And the appropriation bill, which is actually our 2022 budget, has been aptly tagged the budget of economic growth and sustainability. Many of you may recall that the 2021 budget was tagged budget of economic recovery and resilience. So we are moving from a phase of recovery and resilience to growth and sustainability. And during our discourse today, I'm sure we're going to test and validate if we have indeed moved from recovery to growth and sustainability. Also in support of the 2021 budget, the 2022 budget, has been the passage into law of the Finance Act 2021. And as many of you may already be aware, a number of the provisions of the Finance Act is actually tied to the key budget imperatives in the Appropriation Act as we have it. As a result, we have a number of objectives that we hope to achieve with today's webinar. One of it is to be able to facilitate a robust discourse on the impact of the Finance Act and the 2021, on the impact of the 2022 budget and the Finance Act 2021 on businesses and on the economy. We also hope that we can share with you some of the regulatory changes and policies and some of the regulations and policies that are going to be emerging on the landscape, on the fiscal and the monetary landscape in 2022. And then last but not the least, we hope we can also give you some of the strategies, some of the dynamic strategies, which you are participants and your businesses can implement in 2022 for a better outcome. As a result, we have lined up an interesting and insightful discourse, which we hope, will help us achieve these objectives. So to introduce myself, I am Nike James. I'm a partner with KPMG, specializing in the delivery of tax services to our clients. I will be your moderator at today's webinar, and I'm very excited to be here with you. I'm also excited to be able to continue this fiscal discourse that we actually started last year with the Finance Act 2021. So let me share with you a synopsis of our program of events for today. We will be starting very shortly with a welcome address, which will be delivered by Dr. E.J. Didema, who is the president and chairman of council of the Institute of Directors Nigeria. This will be followed by a keynote address to be delivered by Dr. Ayo Teriba, who is the chief executive officer of the Economic Associate. And as you all know, Dr. Teriba is a foremost economist. And for those that don't know, he actually has the interest in the nexus between national financial strategies and the wealth of nation. Can I ask that we please all mute our mics so that we can have a clarity in volume? Thank you. So he's actually interested in the nexus between national financial strategies and the wealth of nations. And I'm sure we see that reflected a lot in his presentation to us this afternoon. Following the keynote address, we will be moving into the panel discussion, and we'll be calling on our panelists who will share with us their thoughts and views from different perspectives. We'll be calling on Mr. Ben Akabweze, who is the Director General of the Budget Office, and will be sharing with us his views on the budget from a government perspective. We'll also be calling on Mr. Taiwo Oyedele, who is the Fiscal Policy Partner and African Tax Lead at PwC. He will share with us his views on the Finance Act 2021. We would also call on Mr. Femi Awoyemi, who is the founder and chairman of POSHIA Nigeria, and he would help us with some of the corporate and business strategies that you can implement in 2022, given these budgets and the Finance Acts that have been passed into law. Last but not the least, we would also call on Mr. Ayo Salami, who is a partner, energy and natural resources in KPMG, and he will be sharing with us some of the areas in the budget that can actually be favorable to the corporate environment. At the conclusion of the panel discussion, we will then move into the question and answer session, and you will be free to ask all the questions they are seeming to ask our speakers. All we ask is that you please pen down your questions in the Q&A box that is provided on this platform, and you can begin to put your questions down at any point in time, starting from now. So at the appropriate time, we bring out the questions and we will table them before our speakers to provide a response to it. At the end of the day, we'll aim to wrap up this webinar in about 2 hours' time, and we'll be wrapping up with a vote of thanks, and we'll be calling on Mr. Dele Alimi, who is the CEO and Director General of the Institute of Directors Nigeria, to do us the honors of the vote of thanks. So at this point in time again, I would like to welcome every one of you to this webinar. My warm welcome to our distinguished keynote speaker, to our panelists, to our IOD executives, and of course, you, our participants. You are all warmly welcome to this webinar. I will now call on Dr. Ije Jidema, the President and Chairman of Council, Institute of Directors Nigeria, to deliver the welcome address. Over to you, Madam.
Thank you very much for this lovely intro, moderator. Thank you. It's really a great delight to welcome you all. Members of the Governing Council and Executive Committee of IOD here present. Our keynote speaker, Dr. Ayo Teriba, the Chief Executive of Economic Associates. Our moderator, Ms. Nike James, Partner Tax Regulatory and People Services of KPMG, Nigeria. Our distinguished panelists, Mr. Ben Akabeze, MIOD, Director General, Budget Office of the Federation. Mr. Taiwo Oyedele, Fiscal Policy Partner, Africa Tax Leader, PwC. Ms. Olufemi Awoyemi, FIOD, MNI, Founder and Chairman of ProShare, Nigeria. Mr. Ayo Lukman Salami, MIOD, Partner Energy and Natural Resources, Tax Regulatory and People Services, KPMG, Nigeria. Gentlemen of the press, distinguished ladies and gentlemen, and all the members of IOD and friends gathered here today. I'm quite delighted to welcome you all to this important webinar organized by the Institute of Directors Nigeria. It is the norm for organizations to invite experts to analyze and present the economic outlook at the beginning of the year to guide their members and various stakeholders. The webinar today is a little bit different in the sense that it goes beyond the presentation of the economic outlook. And it gives active guide to directors on possible scenarios and action steps, particularly in the areas that they have concerns. I'm one of those that believe in the popular saying that where there are hills, there are troughs. Thus, where there are challenges, there are opportunities as well. It takes our collective insights to sift through, identify these opportunities, and navigate smartly to survive, succeed, and even thrive. I'm therefore gladdened by the theme of today's webinar, which simply states in practical terms, the director's prospects for 2022, what will change and what we should do. The 2022 national budget, which is tagged the Budget of Economic Growth and Sustainability, has a spending plan of 16.39 trillion. This is 25% higher than the 13.6 trillion projected for 2021. The GDP growth rate projection of 4.2% for 2022 is considered overly optimistic. to the revised projection of 2.5% for 2021, which was hardly met. We believe that there is a need to examine what these projections would mean for business and by extension for directors in the various sectors of the economy in their decision-making. We are honored to have a distinguished economist, Dr. Ayo Teriba, as our keynote speaker, who will lay a thought-provoking foundation for us all. We are also privileged to have the DG Budget Office of the Federation, Mr. Bernard Kabeze, MIOD, with us. The experts from the highly acclaimed Big Four multinational firms, as well as a great voice in business intelligence in Nigeria, will provide us the versatility that we seek to do justice to a theme like this. In fact, the diverse jurisdictions of the panelists offer us the rare opportunity to query any areas of concern and the privilege to address them or even make the needed clarifications. So we trust that practical issues inherent in the 2022 budget will be brought to the fore. What are the policies and regulations that are new and emerging on the fiscal and monetary spaces? What dynamic strategies can businesses proactively implement for a better outcome in the current year? Where do the key risks lie and how best? Oh my goodness, I didn't read this. My apologies. I didn't know that my video was short. My apologies. So there are obvious questions to ask. What dynamic strategies can businesses proactively implement for a better outcome in the current year? Where do the key risks lie and how best can they be mitigated in a way that they are inherently embedded in the strategy of our organizations? How can we, as an institute, further influence implementation modalities through our advocacies on your behalf? How can we truly be your voice and at the same time be an impactful partner on nation building as we think long-term with sustainability in mind? Distinguished ladies and gentlemen, 2021 was a challenging year indeed for businesses, even though it can be termed a year of recovery globally and even locally, when situated in the pandemic brief in which 2020 was held. As many countries grappled with the health and economic impact of the COVID-19 pandemic, 2021 brought about eased restrictions and gradual expansion of economic activities. However, the emergence of various variants of the virus slowed down economic recovery in many countries across the globe, as new restrictions were imposed to contain a possible fourth wave of the pandemic. However, things are beginning to open up with vaccinations, booster doses, et al., and associated relaxation of movements, normalization of economic activities is in sight. Statistics released by the National Bureau of Statistics showed that 2021 ended on a positive note for Nigeria, as Nigeria's gross domestic product grew by 4.03% year-on-year in real terms, and in the third quarter of 2021 showed a sustained growth over the last 4 quarters since the recession of 2020. The recovery and growth witnessed in 2021 was attributable to contributions from the rise in non-oil sector and the rising prices of crude oil. This growth was, however, submerged by a very high inflation regime in 2021. Inflation rate in Nigeria as of December 2021 was 15.63%. And this occasioned rise in the prices of goods and services across all sectors. These include food and essential commodities, thus making the year a very tough one for businesses, households, and investors. Nigerians are anxious to know what the year 2022 holds for them. There is no doubt that the federal government budget has huge implications for realization of the vision and objectives espoused by directors. The rising insecurity, lingering forex illiquidity, low level of vaccine rate, and apparent lack of way to follow through critical reforms by the fiscal authorities will constitute the major downside risks to Nigeria's short-term growth prospects. Security events which heightened economic recovery challenges include terrorism, extremist insurgencies, banditry and cultism, kidnapping, cyber attacks, etc. Despite a general decrease in terror-related deaths over the past 5 years, according to the Global Terrorism Index, the country recorded the second highest number of terrorist-related deaths, apart from Afghanistan. Recovery in 2022 will be impacted by the effective management of security to provide an enabling environment for business. The threat from the pandemic is still there, even though it appears to be tapering. However, more effective management of vaccination would help. The direction of the global oil market will be a significant factor in the equation, definitely. The quality of the implementation of the government policies and programs would be key. Of course, as we all know, 2022 will be variably affected by the forthcoming 2023 general elections. As political activities get heightened in the third and fourth quarter of the year, there is no doubt that economic activities will be affected. There is documented evidence that preceding 6 months to an election and 12 months afterwards are usually culprits. But distinguished ladies and gentlemen, there is the other side of the coin, the positive outlook. This will only be a test of our resilience and staying power, of course, as a people, and a challenge to our entrepreneurial and innovative capacities. Let's all put on our thinking caps. Nigeria boasts of a population of over 200 million. We have important source of energy from oil and gas, even if it is decreasing in strategic reckoning. We have abundant and unexploited raw materials, and we are important trading partners as a result of our population. There may be a need for organizations to readjust their operating models to fit with the current realities. We may have to embrace new technologies and revenue optimization and cost reduction techniques. The way we operate in the unfolding dynamics of the pandemic is also relevant. Businesses must maintain flexible structure by embracing technology to adapt to changing times. Policymakers should develop a framework that would ensure that Nigeria has a well-diversified revenue base, as proceeds from crude oil have and will remain unreliable. This is pertinent for macroeconomic stability and sustainable economic growth. As I round up, I would like to once again express our immense appreciation to the resource persons for honoring our invitation despite their tight schedules. Our keynote speaker, our panelists, our moderator, we thank you very much. I also thank our distinguished participants, and I look forward to hearing your expert opinions on the matter at hand. I mean, from the distinguished panelists and keynote speaker. I would like to especially thank the Research and Advocacy Committee of the Institute, ably led by Professor Nat of FIOD. I thank this IOD Secretariat and management, as well as participants who have committed their precious time to this webinar. I wish you a productive and successful year, and thank you very much for listening. Thank you.
Thank you very much, Dr. Jidema, for a most gracious welcome address. We have left us with many thoughts in what you have said, and key amongst them is the fact that we need to interrogate the budget expenditure, which is over 16 trillion, and that's why we're here today. And I believe that leads us to the next segment, and where we'll be taking the keynote address that we have been anticipating. So this is at hand now. So please join me in welcoming Dr. Ayo Teriba, our keynote speaker, who is the CEO of Economic Associates. He will be delivering a topic on the 2022 FGN budget and the Finance Act 2021 and the implications for the economy and businesses in 2022. So please join me in welcome Dr. Teriba. Over to you, sir.
Thank you very much, our moderator, the president, and very distinguished panelists, and equally distinguished members of the audience. It is my pleasure to be here, to be a part of this conversation at this IOD webinar on Directors' Prospects for 2022. What will change and what you should do. I think that the theme has been aptly selected. I would like to share some thoughts in the presentation that I will be sharing on the screen. Okay, I hope my screen shows now.
Yes, we can see your screen.
Okay.
Very good.
So, well, the title of the presentation is the FGM budget and the outlook of the economy. And I'm looking at the issue in, 4 parts, and I appreciate there is a very strong lineup of very distinguished speakers, including our very dear DG of the Budget Office of the Federation, Mr. Ben Akabweze. So I'll be just speaking to the highlights on each of the 4 points that I've listed here, so that I can yield to the floor, to others to give us the benefit of their wisdom. So I'm looking at some facts that has been shared with us by fiscal authorities. And of course, fiscal authorities includes the National Assembly and the President, and of course the Federal Ministry of Finance, and then the Budget Office of the Federation. And then I will be attempting to subject them to some realism test. As government policy pronouncements, fiscal pronouncements are one. Reality is another. We seek, that both coincide, that fiscal pronouncements should coincide with reality. And if there are gaps, then you raise the question of how do we close the gap? So what I'll be speaking on some trending issues of the day. First, is a clear understanding of the unfolding global trends. And second is, given unfolding global trends for which you can do nothing but adjust to it. A wise man said, if you cannot change the direction of the winds, you should adjust your sails. So I'll be looking at how should we be adjusting our sails to reconnect to the evolving global trends. And how do we ensure that policy is anchored to wealth rather than some narrow, measure of economic activity? And then I'll conclude on the outlook. And with your permission, I would like to speak to item 3 first, because that provides the context. Much of the things I have and alternative policy choices, these trending issues. The first issue is that we in Nigeria, and by we, I mean government, the federal government, the states, directors, in the companies, should be careful to decipher on unfolding global trends, which essentially is one in which financialization is eclipsing industrialization. And there are just two features of that unfolding global trends. Prospects for transactions and income statement gains continue to dim, while prospects for portfolio and balance sheet gains continue to brighten. And the forces that are dimming the transactions gain or the income statement gains are technological in nature. Techno-economic innovations means that the supply of commodities in the world is fast exceeding the capacity of the world to consume them. Innovations increases the supply of existing products and services and create new alternatives and reduce demand. You can give an example, oil. Technology has given us a new shale technology. 20 years ago, nobody had anything of it. Beyond shale technology, so that creates a glut of oil. It creates new production power base that didn't exist before. But beyond shale technology, technological advancements also create new energy types that compete with oil, the renewable energy sources. Solar, for example. It's not just oil. Genetic modification means that you have genetically modified alternatives to crops. You have genetically modified alternatives to livestock or cattle to grow for you to get meat. People enter the lab and they can provide you meat. The impact of this is to depress global commodity prices. And because, it's technical progress that is behind it, it's sustainable. So commodity prices have been weak over the past decade. They even get weaker going forward. And the downward trends in global export values and global agricultural manufacturing and industry value added reflect declining margins on transactions. We can't ignore that. What that says is what we used to benefit from in the past may not be what we will benefit from at the moment of going forward. Now, the new source of benefit is that portfolio or balance sheet gains continues to grow for techno-economic reasons as well. Financialization wave, which is eclipsing industrialization wave. So, and you see, contrary to the downward trend in commodity prices, you see a steadily upward trend in equity prices, global equity prices, reflecting, liquidity gluts. And such liquidity gluts means that optimizing your asset portfolio is a surer way to gain than trying to gain from transactions, production and trading and the rest of it. And the sustained upward trend in foreign direct investments, the global stocks of foreign direct investment, especially in developing countries, back, that valuation gain. What this says to us is that we need to adjust our sales. You can't ignore global forces. You can't wish it away. So Nigeria, as a country, the states and companies within Nigeria need to rely less on dry streams of transactions and rely more on surging rivers of portfolios. And I am recommending that Nigeria should go after these financialization targets. Companies. Nigeria have many top-grade state-owned enterprises. But unfortunately, we keep trying, the only gain we are trying to extract from those enterprises are outputs, what they produce. If you look at what is happening elsewhere in the world, most leading companies gain more from valuation gains than they gain from sales. And Saudi, a major oil producer, they produce, 5 times or more the oil we produce, learned that lesson. They too own Aramco, which their gain from Aramco have been sales historically. But 2 years ago, they got Aramco listed in the market. So Aramco has a market value, and the value of Aramco is in excess of $2 trillion. Nigerian government has no company that will know its market value. We are missing big opportunities. If Saudi, who exports much more oil than us, seized that opportunity, we shouldn't miss it. We have LNG. It has no market value. Now, so let's know the market value of our corporate assets. When you know the market value, it makes your balance sheet look better, and you access credit markets on better terms. Beyond that, you gain from improvements in the market valuation of your corporate assets over time, just like you gain from their sales. And thirdly, they become securitizable. Much of the debt that Saudi is raising at home and abroad is securitized by its Aramco shares. It's either the government is borrowing directly or Aramco is borrowing. But government owns 98.5% of Aramco. Secondly, most countries gain more from the value enhancement of their cities. We have cities, but what do we gain from our cities? So our corporate assets, I'm suggesting, that could fetch us financial, value that could lift, for example, the budget, lift monetary policy, boost our foreign reserves, are ideal. We don't even list them. We don't even know their value. Our cities, their value potentials as assets are neglected. Our city centers are seized over by hoodlums. Our transit routes are seized by bandits. Our forests, by herdsmen, name it. You know, these are precious assets for other countries. They are potential value sources for us. We have a global city, but we have no global financial center. South Africa has 2 global financial centers. UAE has 2 global financial centers. So because most of our physical capital, land, particularly the one that is owned by government, are almost idle or severely underutilized. And when you look at, you know, the choice assets that I'm talking about, but like China, India are making a lot of money from what they call land monetization. Our land, you have a premium parcel of land next to Eko Atlantic City, but we use it as a military base. We have a premium parcel of land next to Ikeja Cantonment, Ikeja GRA, but we use it as a military base. The United States is a very military state, has a base realignment and closure commission. The task is to look at bases that are uneconomic, close them, you know, relocate them, and turn those bases into great places. Britain has a program for relocating prisons from inner cities. They say aging and uneconomic prisons. We can't be borrowing other people's money and be neglecting assets that could be potential sources of income for us, especially in a world that is very hungry for assets that they can invest in. You know, so all our, you know, idle land across Nigerian cities, we have 774 local government areas. If we highlight, you know, the renewal, you know, of these cities as investment target, we'll get equity investment, not borrowed money. You know, we don't need to go and borrow to invest in infrastructure when you actually present the infrastructure, you know, for, you know, interested equity investors. Basically, this is the motivation for much of the comments, you know, that I make. So we need to realign with unfolding global trends by financializing national wealth. We need to replace over-dependence on GDP, you know, transaction-centric approaches with some balanced attention to portfolio. You can't just be trying to tax economic transactions and neglect wealth extracting portfolio optimization. So that's basically, you know, the long and short of the context. And I would now like to turn to, you know, the facts of the 2022 budget. If we look at the column that I label as new dreams, National Assembly passed the appropriation bill announcing intention to spend 17 trillion, and it's been signed into, you know, law by the president. And it includes an expected revenue of 10 trillion. And my worry is how credible are these two figures? How realistic? And our closest connection to reality are the actual figures for 2021. Okay, in 2021, we wanted to spend 14.5 trillion. We couldn't. By November, we only spent 12.6 trillion. That's an average of 1 trillion a month. So you add 1 trillion for this. So we've spent 13.6 trillion, if you like. So how, if our capacity is to spend 13 trillion, how are we projecting 17 trillion? What magic, what miracle is going to happen over the next 12 months that we'll suddenly be able to spend 4 more trillion? And if you look at the revenue, the main constraint on our ability to spend is the revenue that we can come up with. Nigeria's revenue capacity is reflected by what we did in the last year that just finished. The year ended a month ago. As of November, we only raised 5.5 trillion out of the planned 8.1 trillion. That's average of $0.5 trillion a month. So if you added $0.5 trillion for December, our revenue capacity is 6 trillion. So how are we projecting 10.74 trillion? So where is that 4.74 trillion going to come from? And when I look at most of the expectations of revenue, it's basically telling us that this is our economy that is in a recession, that has recently suffered massive devaluation, that is trying to survive a prolonged pandemic, which is in its fourth wave. The government expects more tax revenue from that sort of an economy. And I'm saying that's a dead end. You can't expect an economy that is in a recession or that is recovering from a recession. If it grew by 5% since the second quarter, it's not even up to the decline that we suffered the year before in the second quarter, more than 6% dip. We are not even back to the pandemic. We are not recovered back to the pandemic level of economic activity. And we keep expecting more tax revenue from this. And I said that's unrealistic. Most governments in this situation would be injecting more subsidies into their economy, even if they have to borrow it, not tax that economy. So that's one point. Second point, okay, so we got 6 trillion, but we spent 13 trillion, which means we borrowed 7 trillion last year. So the budget last year, the 13 trillion we spent was funded more by everybody's money than by government's money. Now we are planning to increase the spending, and I doubt that the revenue will be any more equitable. My best expectation for revenue is we could do the same 6 trillion again, or maybe do 7 trillion, not 10 trillion. So if revenue disappoints, we are likely to borrow more than the 6 trillion that we are projecting. And if you look at the quality of our borrowing, the nature of our borrowing, it seems, we paid 4.2 trillion or 5.5 trillion revenue on debt cost, on interest payments. That's 76%. So revenue is low, but the little revenue there is, 3/4 of it goes on interest payment. And when you look at the breakdown of the interest payments, domestic debt, 2.2 trillion. And foreign debt, about 0.9 trillion. But worryingly, ways and means advances is 1.1 trillion, which is half of the 2.2 trillion we paid on domestic debt. And then I say, so are we saying ways and means advances from the central bank was as large as half of the total domestic debt? That's worrying. So it's not as if we have that borrowing capacity at 4.2 trillion annual payout in 2020. We pay 4 trillion. And that was more than the revenue of the federal government of 3.99 trillion. So it's not as if we have, such borrowing. We are at the limits by the time we are doing extra budgetary ways and mean borrowing. So these are some of the realism concerns that I have. And if you ask me, budget realism comes down to fundability. So if you can't fund it, it's not realistic. And when you get funding shortfalls of 2 trillion on capital votes of 5 trillion, it's worrying. So I'm concerned that we have to do more on funding the budget. And this message is not narrowly to the budget office or to the Ministry of Finance. It is the National Assembly that no, the budgeting is an appropriation issue, is a legislative issue, and in any presidential system, the National Assembly has the final say. President can veto, but they can overturn the president's veto, and the president has no recourse. The president has no choice but to execute once the National Assembly passes. That the National Assembly, I can't question the powers that have been given by the Constitution to add to spending. But I'm urging them to pay attention to how to find the money to fund this spending. And that Nigeria's capacity to raise revenue is better than 6 trillion a year. But it's not going to be tax revenue. It's going to be non-tax revenue from idle assets. Any tax revenue that you mobilize now, you are robbing Peter to pay Paul. It's not net gain for the country because they are just taking from one part of the body and grafting it in another part of the body. That's tax revenue. But non-tax revenue is net gain for the country. If you relocate on economic activities from prime urban land and you release them for redevelopment and leases, and it brings revenue to the country, it's net gain. Nobody lost anything because you will rebuild an ultra-modern, military base or prison at an economic location. So it's a win-win situation. So let's look, if you list our corporate assets and we make valuation gains from them in the market, nobody loses anything. So basically, these are the kind of, concerns I'm expressing about, the facts and the gap between the budget facts and reality. So when you can't fund the budget in full, the control of the budget is lost. Funding shortfalls means that budget gets tossed to and fro by the economic conditions they are meant to guide. And it raises fiscal credibility problems. Fundamental disconnect between fiscal pronouncements and realities. Revenue and spending programs look rather fictitious. And it reflects growing executive bias, which is increasing the distances of key budget figures from realities. So basically, these are the, the concerns that I have. I'll just go now and try to conclude on this so that we can benefit from the wisdom of others. Show me a continent, country, region, state, or city that is liquid, stable, and growing with socio-political harmony. And I will show you it is optimizing its public assets. Show me one that is illiquid, unstable, and declining with socio-political disharmony. And I will show you it is not optimizing its public assets. Assets can always be optimized to fix or rejuvenate all other balance sheet and income statement items. The GDP is not the economy. It is merely the annual output from the economy. Economy is the wealth stock that creates both, GDP, which is real transactions, and portfolios, which is financial. So we seem, narrowly focused on real transactions, and we neglect financial portfolios, in which we can turn to our corporate assets, physical assets, intangible assets, and even human capital to unlock economic value from them. And you use debt and equity liabilities. The only kind of liability that the Nigerian government issues is debt. But it's better when you attract equity into your asset because it unlocks new revenue. It gives you new revenue. It opens new opportunities. So I'm saying that we should improve not just the revenue that we generate by turning to assets, but we should improve the quality of our debt. By linking the debt issues to assets, we should issue some investment grade bonds. The world categorizes in, debt into two. There are investment grade bonds. Any bond below the investment grade is a junk bond. We shouldn't take pride in having a national debt portfolio that is all junk. All our domestic debt instruments are junks. All our foreign debt instruments are junks. We should tie debt issues to assets to upgrade their quality and reduce what we pay. 4.2 trillion out of 5.5 trillion in revenue is killing, and it has to stop. And once you begin to securitize debt, you move away from interest-paying debt to non-interest-paying alternative. And securitized debt is very close to equity. You know, the difference between securitized debt and equity, outright equity, is convertibility clause. So you can have a clause that when it matures, it's convertible to equity, and there you are. So I wish Nigeria very well. I am saying that if we cannot coherently deploy a policy instrument as fundamental as an annual FG spending plan, then we can't be expected to hit any of our, policy targets of stability, growth, diversification, poverty reduction, and employment. So the budget is an instrument to realize targets. And when budgets fail, it's like, a tennis player trying to serve, but the ball drops in its own court rather than crossing the net. If we cannot credibly fund one-year budget, then we cannot be expected to credibly fund five-year plan that promises to accelerate growth, diversify growth, and sustain development. Annual spending plans must be funded in full to ensure our medium-term plans do not keep ending up as attempts to build castles in the air. Seeking increased government revenues from economic transactions at a time that local operating margins are dwindling is a mirage. The surest path to full and effective funding of our annual budgets and five-year plans is to turn to our portfolio of national assets and unlock liquidity from them. I thank you very much for your attention. I now yield the floor. Thank you.
Thank you very much, Dr. Teriba. What an insightful discourse and analysis you've just shared with us. Sorry, can you all hear me? Hello, am I heard?
Yes.
Yes, we can hear you.
Okay, thank you. So thank you again, Dr. Teriba, for that insightful discourse that you shared with us, in terms of the economic outlook and our national budget. I take away a few things, very key things from what you have shared. You've talked to us about the gap between, the budget facts and reality, and that is really big. For an economy that's recently recovered from recession and that has suffered massive devaluation recently, and we are still recovering from the pandemic, that how indeed do we expect to increase our tax revenue generation, that it's quite unrealistic. So in as much as it's a funding issue that we have with the budget, but the reality is not tax revenues, but we should be looking at non-tax sources, which are essentially our portfolio of national assets and balance sheets. Very, very insightful, and thank you, Dr. Teriba. I'm sure our listeners, our audience, you are all teaming with your questions, and I would ask that you please pull down your questions in the Q&A box that we have provided on this platform. We'll be coming soon to post those questions to Dr. Teriba. But at this point, we would like to progress to our panel discussion. And I'm sure that Dr. Teriba's presentation has really given a good fodder to our various panelists to be able to share with us their thoughts on it. So I will be starting by calling on Mr. Ben Akabueze, the Director General of the Budget Office of the Federation, to please share with us his reactions on Dr. Teriba's presentation and also his thoughts on the budget. I'm sorry we have limited time for each of our panelists. We have just five minutes for you to share your thoughts. So So I hope you will be able to make the best use of that time. So over to you, Mr. Akabweze.
Well, thank you, Nikki. And since I have very limited time, I will not spend any of it on protocol. But let me say that if this forum is indeed intended to inform, then asking me to react in 5 minutes to Dr. Teriba's presentation, certainly I'm not sure you then want a proper reaction. Great presentation from my friend, Dr. Teriba. But the truth is, unfortunately, he started from the premise that we needed to be realistic. But I think that his presentation suffered significantly from a lack of infusion of reality. We are having a discussion here about what is feasible and what we can simply accomplish, in terms of the annual, budget. And you cannot, divorce your annual spending plan from your current political, reality, or the political economy. So let me begin by looking at, and maybe that's what I can really spend the limited time available on, the budget for 2022. I think that basically Dr. Teriba has focused on top line numbers without drilling into the details. So if we had looked at the Appropriation Act and looked at what constitutes the 10.74 trillion, you would have found that in the 10.74 trillion, there's hardly any growth in projected taxes in there. So, I mean, he spent considerable time talking about the unrealism of planning to tax, off the back of, a recession. 2020 was the COVID year, the main year when COVID really took an impact on global economies. And 2021, therefore, taxation is on a preceding year basis, at least on the corporate tax side. So I think if anything, I mean, just on the basis of that, we should expect some improvement in corporate taxes in 2022 over 2021, given the base on which those taxes are. But despite that, when you look at if you unpack the 10.74 trillion, you find that 3.6 trillion was supposed to come from oil, sources, and the aggregate of, taxes and, custom duty and all of that was about 2 trillion. And then you have dividends, 195, then you have aid and grant, 63, you have special funds and accounts receipts, all the rice, whatever levies and sugar levies and all of that, 300 billion. Then you have from government-owned, enterprises, okay, their own retained revenues, because the budgets of 63 government-owned enterprises are now integrated in the budget for the federal government. The share of the revenues that they retain, okay, and this includes NPA, NIMASA, all of those, 1.7 trillion. But then what we call government independent revenues, which are the surpluses returned from these agencies, also the various user fees and charges by government agencies, and what you call consolidated taxes, or certain personal income taxes that accrue to the federal government. That comes to 2.2 trillion. And that's where we have a significant thing. What is when you compare that to the in 2021, government independent revenues closed at about 1.3 trillion naira. So finalizing the December number as of November, it was 1.1 trillion. And we're saying to go from that 1.3 to 2.2, because we've continued in the 2020 Finance Act for the first time, tried to impose a cost to income ratio ceiling on the spending of these agencies. And that's why we saw in 2021, the independent revenues go from 500 plus billion in 2020 to 1.3 trillion in 2021. And we're persuaded that there's still a lot of leakages in those places to plug. So the revenue projection is not based on taxation. However, the key the key risk point in the revenue projection has to do with oil revenues. When we speak about oil revenues, people often think it's just about profit oil. No, the petroleum profits tax, the royalties are basically the key sources of this. This budget was prepared on the premise that the petrol subsidy will only last up to June, and after July, there'll be no petrol subsidy. Now, with that being pulled back, that is the real risk point now, because then the way the petrol subsidy regime operates is that NNPC, which is currently the sole importer of petrol, given the fact that prices are subsidized, essentially subtracts whatever cost of this subsidy from the revenues upfront before it remits to the Federation account. And so yesterday, in the presentation that we took to Council for approval, we're basically saying that the reversal of this will create a 1 trillion naira gap in the revenue projections for the federal government for 2022. So other than that, I think Dr. Eba needs to look at the numbers more closely. In terms of, if you even look at factors that, the 4 trillion you're trying to explain, exchange rate, 2021 budget based on 379, 2022 based on 410, that's 8.2%. So all dollar denominated revenues automatically go up by that amount. In the 2021 budget, up to 2021, TED fund, which is a 2% education tax, this had up until 2020, up to 2021, not been captured in the budget. And that money has gone straight on to TED fund. And from 2022, that's been brought into the budget. There's a 306 billion naira in there, which wasn't in the 20%, which all count towards, explaining the movement, in revenue. But bottom line is there's not much in terms of tax component in the growth. And then, I mean, I'm on board with all of the proposals in terms of financialization, all of the shift from, and Dr. Eba knows that he and I served on a committee. He and I served on a committee 4 years ago, 4 years now, that made these recommendations.
2019.
2019, yes. And those the political, has not, bought those things. And partly because, the recommendations we made then included rolling back petrol subsidy. We've seen how difficult it is to do because, of this reforming public finance is not flicking a light bulb. So to that in 1 year I mean, if you're going to our most valuable companies, probably ultimately, NPC, not with NG, you're not going to basically list that without PIA was going to be a step in that direction. So you can't possibly achieve that in 2022. NPC has no track record of profitable trading, listing, you probably won't get your top value. NLNG, Saudi Aramco is 98% of Aramco, so it can do what it pleases. NLNG, the government, Nigerian government is 49%, it's a minority. So you'll have to carry your partners in this thing have to agree to a listing. You can't just do it because you want to do it as government. Right now the discussions are advanced about redeveloping places like Ikoyi prison, sitting on prime real estate or whatever, there's massive pushback and resistance. But even if that was going to happen, it's not going to be a source of funding your budget in 1 year. These are things that would time to deliver, because as you take this money out, it's going to go into, first of all, investing in the alternative prison, whatever facility that you're going to move the people. You won't shut the prison down overnight. So it takes this to develop. So these are, since we are discussing the 2022 budget, we needed to basically speak to options that can deliver. And I'm hearing about non-interest debt. I know about equity. I understand about all of this, turning your assets, whether they're corporate or physical assets, but I'm still waiting to be properly educated on these non-interest debt options. People talk about sukuk. Sukuk, as far as I'm concerned, is non-interest. But the Nigerian end of sukuk is not the pure sukuk. There's something called a rental rate. The last sukuk issuance has a rental rate of 12.8 something percent. So it's not called interest, it's called rental rate. Does that make it non-interest? As far as I'm concerned, no, because we will provide for that so-called rental rate. That rental rate is part of our provision for debt service. It's not. Why is the debt service projection? I think it's because you did 4.2 last year, you must necessarily do more. No, that 4.2, as you saw there, 1.1 trillion was from CBN Ways and Means, because it was an overdraft sitting at CBN on which CBN was charging penal rates. For 2022, that's being securitized at now a rate that is about 3% or so lower than what you paid in 2021. So that is a significant shave off the debt service. So let me stop because of time. But the bottom line is our 2022 budget, like all budgets, is aspirational. It has a stretch factor. But to dismiss it as unrealistic, to dismiss the underlying assumptions as unrealistic, I think is not an appropriate characterization of the budget.
Okay, thank you very much, Mr. Cabrezi. That was very insightful, and I think that you did a very good job of coming back to clarify the basis of the 2022 budget. We hear you, that's in the details. It's not just looking at the top lines, but in the details, we find a lot of facts in what has led to that budget. And we also have to consider that with devaluation, obviously the costs of expenditures have to go up appropriately. So thank you very much. I think during the Q&A session, we can get maybe some rejoiners from Dr. Teriba, and we can have some more clarity on some of the things we talked about, non-interest and the rest of that. So I'll quickly move to our next panelist, I've graduated you to Dr. Mr. Taiwo Yedele, and I will be asking him to please quickly give us his reaction on Dr. Teriba's presentation and also share with us thoughts on the Finance Act 2021. We did give Mr. Kabreze a bit more time, given the sensitivity and importance of his own side. I think eventually had 15 minutes. But I ask our other panelists to please help us keep to the 5 minutes that we have scheduled for each of their discussion. So over to you, Mr. Oyedele.
Thank you very much, Nike. I think I'm largely in alignment with the lead speaker's presentation, so I won't spend time trying to respond to that so I can maximize my 5 minutes speaking to highlights of the Finance Act implication for businesses and also the need for government to expand its tax net. First, I think in terms of the Finance Act, it's always very important to remind everyone that these are not the easiest of times. So it's easy to, point fingers and criticize, but the reality is there's no silver bullet. It's a period where government would love to provide fiscal stimulus, but there's no fiscal space. And it's also the time that government needs to increase revenue for very obvious reasons. So in terms of the implications generally, I thought maybe I should look at it from the perspective of, how does it affect the ordinary people, the not so ordinary people, their investments and businesses. So for ordinary people, I think maybe two amendments that would impact on them. One is the amendment to remove educational institutions from the exemption list. So which means schools are now liable to pay tax. And what I expect to happen is schools will adjust their fees because unless they're really profitable, which I'm not very sure about that, they want to adjust their fees so they can pay taxes and also still remain in business. So that would affect the ordinary people. Maybe some people will say ordinary people don't send their kids to expensive schools, but I think that's debatable. The other one is on excise, on non-alcoholic beverages. So I think the very large extent, even though you say these are not the poorest people in Nigeria, because poorest people in Nigeria, I used to be in that category. We took Coca-Cola once a year, so we only took it during Christmas. But we also have a good number of Nigerians today. If you go to Ajegunle, for example, that a meal for them is a loaf of bread and a bottle of soft drink. So to that extent, the excise tax will impact them. So even though the tax itself is not extremely significant, but the way it's going to play out is that if you make an adjustment of 10 naira per liter and you have the average bottle as 33 cl, which is 1/3 of a liter, you're not going to divide 10 by 3. People will just move it to the next round number, which is likely going to be 10 or even 20 in some cases, additional naira. On not so ordinary Nigerians, we have the digital services tax, where in fact, it's not a new tax, but the implementation is new based on the Finance Act, where digital services companies will have to pay companies income tax, and they will have to also charge VAT and remit to the FRS. So what that would mean for the people that have been impacted is that you then have to pay a little bit more because the prices you pay for those services would now incorporate the taxes. I think, the digital services reform is necessary because Nigeria did not sign up to the global treaty. So we need to find a way to take care of ourselves. But I guess this is something where you continue to improve until you find the right formula that brings in revenue to government without being counterproductive to the system. On investment and businesses, I think the first one is capital gains tax on shares, shares of 100 million naira or more in any 12 consecutive period or months rather. So this is one of the areas where the ordinary people will not be impacted directly. It will impact, high net worth people and also corporate investors if they do not reinvest. The way to avoid that tax is to reinvest the proceeds. And also we have a number of taxes that would affect businesses. The education tax has been increased from 2 to 2.5%. We now have the implementation of police levy. It's very small, 0.005%, but you have to comply. There's also a tax for engineering and science agency, NASENI. That's 0.25% for some organizations like, financial services, banking, for example, like, airlines, and telecommunication, and a few others. And we have some, incentives in the capital market that have elapsed and haven't been extended. So I'm hearing a sound. I don't know whether they're trying to call my attention. Otherwise, I would suggest that everybody should be on mute if they're not speaking. So these impacts on the capital market will mean that corporate bonds will be more expensive than before because the exemptions are no longer there. So corporates who want to raise capital by way of bonds have to prepare for, higher interest rates. Implication generally is that for businesses, this is the time to comply because the penalties also have gone up in the laws. So various penalties have been amended to make them more punitive. And the reality is that many of the taxes and the penalties were last amended like 20 years ago. So sometimes you see the penalty and you think that government is even a joke, right? So I really, in principle, don't have a problem with penalty rates going up, but just to make sure that we don't then divert our attention to trying to promote voluntary compliance into trying to generate revenue using penalties. Some of the provisions in the Finance Act will help to improve the business environment and the ease of paying taxes, which is good news. One of that is FRS being the sole agency for the federal government and for the federation. What this means is we should see less audits from all manners of agencies, which is really a big burden on businesses. So if everybody coordinates with the FRS, this will be less burden on the business environment. And then there's a lot of emphasis on use of technology, which we all agree is good for the system. There are opportunities in terms of minimum tax. Government says within 3 years, from 1st of January 2019 to 31st December 2021, you can choose 2 years, within that period, for which you want to apply the reduction in minimum tax rate. So this is an opportunity for businesses that are affected by minimum tax to reduce the burden on them. And then for unit trust, withholding tax on interest is the final tax. So this is also good news. Many of us invest in unit trust type of schemes. So when they earn interest and withholding tax is deducted, they would not have to pay any further taxes. Or even in many cases, the withholding tax would not be applicable. So finally, to wrap up, and the other point is the need for us to expand the tax net. And I want to start first by saying we have to stop the bleeding. I think that the Treasury is bleeding. I have been very sad since the reversal of the decision to remove subsidy. Sad because I know that this is one of the biggest, challenges that we have to deal with. And unfortunately, it seems like the solution is not in sight. If you're having to budget around 3 trillion to just pay subsidy, that 90% of it goes to the wrong people. Wrong people because in my estimation, I think half of it goes to criminals who are just smuggling the product. Another 40% maybe to the middle class and the elites, and the poor people only get maybe 10% or less if you analyze it properly, given that diesel is already deregulated, kerosene is deregulated, large consumption of petrol does not benefit the poorest people. If you think about that, and just put it in context, this amount we're talking about is equivalent of suspending personal income tax and VAT for a whole year, right? Just imagine that. And I'm hoping and still praying that some magic will happen and Nigerians will reason in the best interest of the country and not just what is politically correct or vested interest for us to find a solution to this. I do think that the implication on inflation will be much less than people think it will be. Because if you take out the corruption in the subsidy of people smuggling it, the real subsidy is maybe around 1 trillion. Nigeria consumption GDP is about 136 trillion. So that percentage is even less than 100 basis points, which is less than 1%. And then we need to find a way to use data and technology to get intelligence so that people who have the ability to pay are paying more and we can protect the more vulnerable sector of the society. And we need to further harmonize taxes and agencies. Many of the taxes we have are just creating unnecessary burden without yielding revenue to government. Let's repeal them and then focus on broad-based, high-yielding revenue, and then address structural tax inequity in Nigeria. So those are the points I'll make. I know maybe my time is already up, but thank you very much.
Thank you. That was a passionate response that you gave there in terms of the situation with the Finance Act and what you see as what government needs to focus on. I had a question for you, but I will ask it, but you won't answer, and they're doing the Q&A. I want you to answer it. With all the new taxes that are coming up, digital services tax, tax on sale of shares, excise duty, educational institutions paying tax, what do you think the impact will be on the tax to GDP ratio? Do you think we still remain 6% or it's going to go up appreciably? But don't answer yet, just hold on to it, and then we'll take it during the Q&A. And to our participants, please don't go away. We still have 2 more panelists to give their views, and I can see your questions have started coming in. Thank you very much. Please remember to post your questions in the Q&A box, not on the chat box. So if you have it on the chat, please move it to the Q&A section, and we will be in the Q&A section shortly. So I'll quickly move on to our 3rd speaker, panelist, Mr. Femi Awoyemi, who is the founder and chairman of ProShare Nigeria. And I will simply ask you to go straight and share with us corporate and business strategies for 2022 and other thoughts that you have for our participants. So thank you, and over to you, Mr. Awoyemi.
Thank you very much. I will try to maximize time because it's necessary to interrogate the conversation between Teriba and Ben Nakabweze, which is a very fundamental one, which speaks to the issue of strategy and the need for freshness in strategy as regards to the budgeting process for Nigeria. I would therefore just make some few quick points, given the short period we have. One is that there are certain things around the budget which Ben Akabweze mentioned. He said that we were just coming out of a COVID year from 2020, 2021 was this. But the fundamental problem around this thing is not something that happened in the last 3 years. It has occurred over the last 10 years, even the last 2 decades. There is a misalignment between our budget and the linkage necessary with the National Development Plan. For one, whereas the budget focuses on the zero-based budgeting approach, the National Development Plan is a 5-year project which requires continuum. That lack of harmony in principle and structure presents most of all these challenges that make sure that we just look at it on 1 year alone. Secondly, the inability to fund a single year's budget is a serious issue. And it is important for government to understand that the unspoken words before, which were mostly in muted whispers, are now moved on to grumbling and now becoming articulated concerns and responses from people. And so, given our last conversations at the Lagos chambers before, it is necessary, therefore, that there must be some meeting of minds, either to gain a better understanding from your solid perspective. But I do know, given your track record, that you are not simply just saying this because you work in government, it's because you believe in it. And I want to agree to that. But there seems to be some schism between how you see the country and our expectations from it. That being said, 2 other issues. One, this concern about taxes and people talking about growing taxes and what have you. I agree with your point, but I want to lean more onto what Oyedele also said. See, you cannot tell people that they are not paying taxes. I can't recall anybody around me that are not paying taxes, but most of the taxes are going to non-state actors. And there must be some deliberate approach to deal with that gap between what people are paying and what the non-state actors are collecting, apart from the mismanagement and the gaps within the revenue collection system, which the Ministry of Finance has done quite a lot of work in trying to bring together. But there really is an issue there. And so whenever we talk about the people that are not paying enough taxes, I think we should put it in context. And this goes to the point I want to say, that coming off the back of a recession, a devaluation, and a pandemic, and the associated waves and fallouts in the last few years, incomes and business profits have taken a hit in many sectors. Models are now being redefined for corporates. Strategy shelf life, indeed, has shortened. In fact, most organizations and most directors are having to have more and more shortened versions of retreats to strategize and change things. And why is that so? Policy instruments, which is basically captured in the budget, these are the policy targets, are not working the way it should work. I'll give you one example. There was a recent circular by the central bank on all import and export operations will require submissions of e-invoice. That policy makes more sense so that we can aggregate it. But therein lies the problem. You are asking MSMEs and people in that business to be paying $350 per annum. The whole goal of the budget is not necessary to keep on collecting. There is a tool called incentives being used, but we keep on piling the pressures on companies. There are bills in the National Assembly that require people to pay certain percentage of profits. The business community is concerned that if we took a whole list to look at all the requirements for them to pay a particular business, the cost of business is not going to support the policy requirement to create employment, to also allow for growth to occur in the economy. And so the concept of financialization, which Teriba spoke about, becomes key. What you then see is that financial experts, financial institutions, and those who should be in the know are now making a better case for talking about how the economy policy and economy outcomes would have to be decided. But I think, without taking too much time, is that what is happening now is that the directors of companies who have to deal with accelerating levels of uncertainty, threats, and new opportunities that are coming that will impact their productivity now face new risk profiles and business performance in the year, which should interest the government. What we're saying in essence is that people will keep on changing, adapting to disruptions, and also identifying new areas of growth. It is government's responsibility to also engage with the organized private sector to see how we can carry us along to understand it. For example, we do waivers, we do concessions or whatever. We've never bothered to measure the impact. And I do know personally that the cost of all these waivers have not been positive to the economy, not even captured directly in the budgets which we present. I think that this conversation may be better off if the budget office were to invite the private sector and people to speak, to come together to gain a better understanding of your own, hear those concerns which directors are facing currently, and let us find a way to do it. Rather than a talk session, we must really deal with them because it's really creating a lot of challenges for people. Having said that, there are new opportunities for growth. What that means is, therefore, is that as new opportunities emerge, there are challenges to the issue of employment because not new employment are being created, but new skills are being required, which requires an integration into the changes in our educational system and a number of dislocations that are occurring. Businesses are shrinking so that they can become more efficient, but it's impacting some other areas of the economy. So by summary, the concerns around the budget and the concerns for the corporate and business community are that we are all here. We are committed to listen to the government in terms of the hard choices that needs to be made, but we cannot be passing policies that do not make sense. Lastly, it would be remiss on my part if I do not go back to this issue of this circular, which bothers me very seriously, because I do not understand whether it is the CBN who should be making such decisions around fiscal positions, as I have seen, asking people to set prices at 2.5% around vertical prices. You do not have a uniformity of pricing. How would that work? How would that work even for NNPCs in terms of its oil production? I understand that there are lapses in the Form M process, but these are issues we have to deal with, and there must be means in which we have a feedback and discuss and deal with those issues. Thank you very much.
Okay, thank you. Hello? Okay. I think there's an echo. If somebody has two devices that is connected, please disconnect one. Okay, thank you. So thank you very much, Mr. Awemim, for that very also passionate and insightful discussion. You couldn't but help but react to the discourse between Mr. Akabreze and Dr. Teriba, and we take notes. So really not being able to fund a single year's budget is really a key issue, and financialization now becomes key. And I think we've also taken notes in terms of there needs to be a forum for directors to be able to bring to the attention of the government in terms of the new risks they're facing. I'm sure Mr. Akabreze will try to do something about that, a session maybe sometime during the year to bring that to fruition. So thank you for those thoughts. And we'll now move to our last but not the least panelist, Mr. Yosalami, partner, ENR in KPMG, to share with us his thoughts, maybe now more particularly in terms of maybe those areas that are in the budget that can be advantageous and favorable to the corporate environment. So over to you, Mr. Salami.
Thank you very much, Nike, for the introductions. In the interest of time, I need me to stand on the existing protocol. Dear participants, distinguished participants and panelists, good afternoon. I'm happy to share my thoughts on the aspect of the budget that are favorable to corporate environment, as well as boost competitiveness of Nigerian economy as a whole, generally. I think the first point to make here is that the culture of passing annual budget on 1st of January has been entrenched by the current administration. And kudos to the President and the National Assembly for achieving this. In the last 3 years, they've consistently do this. I must say that businesses don't thrive in an environment of uncertainty or lack of clarity regarding government policies and programs. So for government to come every year and roll out the budget pronouncement on 1st of January is a good way to go, as it spells out what government's plans and policies are for the year, and in a sense, also provide a kind of platform for corporate organizations to also begin their planning. So I think that is very good for business. Second point is around the context of the budget itself, which has been tagged budget of growth and sustainability. If you look at the content of that budget, I think in a sense, it's expansionary in nature. And I will explain that very quickly. If you take a look at the spending, the planned spending on personnel costs, on MDAs and government-owned enterprises, it's run to the tune of about 4.5 trillion naira, which is in a sense about 10% above the level in 2021. So my sense is that whether that increment is going to be due to new employment or increment in salary levels of current employees, I think in a sense, it puts more money or disposable income in the hands of employees. And if the government has been touted as one of the largest employers of labor, if you combine that with the fact that even in that same budget, you've got amounts running into billions of naira for defraying outstanding obligations to contractors and the rest, I think that can enhance their disposable income as well as, in a sense, also create an uptick in consumption, which ultimately would mean for corporate organizations and producers, they would have an uptick in their turnover and revenue, particularly those companies in the FMCG sector. So for me, that is also a positive for business. The third point I also wanted to talk about is the VAT rates. In that budget, government has maintained the VAT rate at 7.5%. Again, the government did have a choice to increase it in view of the fact that they have funding challenges, but they chose to retain it, even though we know that that is the lowest VAT rate across most countries in Africa today. But again, if you look at the components of our budgets and actual reality in the last 3 years, you will observe that VAT collection has a potential of delivering more revenue at the least possible cost of collection to the government. Put it in context, if we take a look at the 2020 actual, VAT collection was about 172 billion naira. In 2021, that number more than doubled to 370 billion naira without any increment in rates. So the point I'm making is that government did have a choice, but they chose not to increase the rate to enhance their revenue. So again, it's a positive for business because at the end of the day, it then, in a sense, won't contribute to the cost of doing business in Nigeria. So much of that. Let me now talk quickly, very quickly. I think it's be injustice for me to not talk about this. 2 areas in the budget which I find a bit quite disturbing. The first is in terms of the general theme of the budget. I think it's still a bit public sector led than private sector led, and I'll explain that very quickly. If you take a look at the 2018 budget, I think I'm right, 2018, there is a line item, a revenue line item called oil joint venture asset restructuring. And the government hopes to realize about 710 billion from that exercise. Right from that year till to date, that line item no longer appears in our budget. So I asked myself, what could have happened in the face of building revenue that government could not take this initiative to the end? Perhaps we could say then that the legal framework for that kind of initiative was not there. But I thought on the back of the PIA, which was passed last year, that legal framework already exists. And the government will take advantage of it to sell down its assets, its equity interest in JV assets, and realize the much needed fund, which again ties to the point that Dr. Teriba made earlier on around optimizing public assets. Apart from that, you also see in the budget that there's an expectation of about 90 billion naira from privatization proceeds. And I asked myself, if we achieved as much as 206 billion last year. Why are we having a low expectation of 90 billion this year? Does that mean the government doesn't intend to focus on prioritizing those assets and optimizing their value? It's a question that I just thought I should ask, because for me, if we are sitting on those assets and we can sell them to optimize their value, to unlock the current value they have, then perhaps our level of debt will not be as high as we speak today. Second point to also talk about is with respect to the debt service to revenue ratio. Last year, it was approximately 76%, according to the budget announcement. This is quite, I don't think it's sustainable for obvious reasons. The question is, if we do know, and of course I understood all the reasons given in the budget, they mean that, oh, the deficit is actually being spent on human capital and capital expenditure, which are the reasons that are then the fiscal responsibility for you to have that kind of level of deficit. But I think the point is, if our capacity to generate additional revenue is not as high as our capacity to borrow debt, then we should be very, very careful at the level of debt we borrow, because ultimately we may wake up one day and discover that we're actually borrowing more money to service existing debt obligation. And I don't think that is where we want to be as a country. In the interest of time, let me pause here while I can take other comments in the next segment of Q&A. Over to you, Nike.
Okay, thank you very much, Mr. Salami, and thank you for doing very good justice in terms of our timing. And we have heard you in terms of some of the key things you've told our participants that are positive points from the budget, including, I think the third one I got on VAT rates. Government had the option to increase them more, but they chose not to. But again, government have areas to work on. Budget of public sector, budget is still public sector led, rather than private sector. And privatization, it seems we could do more. So possibly in next year's budget, we'll see more focus on the need to actually extract value from our national assets. So thank you all again, all our panelists, for all those insightful feedback that you have shared, and to our keynote speaker as well. At this point, we'll now go on to the question and answer session, and a number of questions have been put down. I will try to prioritize in terms of the questions that seem more prevalent, and also to distribute amongst our keynote speaker and panelists, and to see how much we can go. Our time is, we'll see how much we can go. We still have at least some healthy, maybe 20 to 30 minutes we can still spend on Q&A session. And I'll start with the first question, which goes to Dr. Teriba. And it goes that we are financial advisors to what are the financial advisors to our leaders doing? Our idle assets continue to depreciate over time. Can we go cap in hand, borrowing to finance recurrent expenditure and not infrastructure that yields profits? Dr. Teriba, do you want to address that? Though it seems more like a question that we should give to Mr. Akabreze.
Okay. Thank you very much, moderator. Well, the question is about what the financial advisors to the powers that be, what are they doing? And I like to say, the person asking the question, that you are the financial advisor, to the powers that be. We all are the financial advisors to the power that be. Correct. We elected the people who exercise the power into government, and they can't ignore what we say. So that's why a forum like this is
Hello, Dr. Teriba.
Many of these recommendations on financialization were in agreement on them. We worked on the minimum wage, presidential minimum wage committee together. We recommended many of these things, and still stuck with the powers that be. So much of the sentiments we express is not, I said it during my presentation, is targeted, not narrowly at the Ministry of Finance or narrowly at the Budget Office of the Federation. But the center of power in budgeting, in appropriation, is the National Assembly. And so where, recommendations that could put the country in a better situation sits down for years. And Ben did say I should be realistic about the political economy context, which is, the point. So our role is to call for these changes. And we've seen countries, that are even more strongly politically averse towards the exploitation of the market value of national assets. Like China, that was a very strong communist state. Now, China is financializing. The state is leading the process. Like India, that was a very strongly socialist state. Now, India is financializing. The state is leading the process. They have listed more than 10,000 national assets in their India investment grid that they're trying to attract global liquidity into, and they're succeeding. So it's what we say, and I'm glad that we seem to be working towards a consensus to try and ensure that these things are done. And the point that the questioner is raising is, why, pile of debt when you can unlock resources from, national assets? So debt issuance is inevitable. There's no country in the world today that can say, I'll survive without borrowing. You should borrow. So you had better learn how to do a good job of it. Paying high interest cost on debt is not inevitable. You should explore cheaper borrowing options. And when you have assets in question, particularly revenue generating assets, that's the basis of, the debts that you are issuing. Ultimately the costs are lower. I think I will pause there so that more questions.
Thank you. I'll quickly ask you a second question before I go on to our next speaker to just try to distribute on the time. And it's a question that has that what non-oil sectors should FG look to stimulate growth and development aside from agri sector? And when is the right time for the federal government to remove subsidy? In your view, Dr. Teriba.
Okay, now, a major point in my presentation is that transaction centrism, which production sector is an outdated model of making economic progress. So it's not manufacturing, it's not industrialization, it's not agriculture. The key thing is your national asset. So the question that how that applies is why is not sector is what value are Nigerians adding on the farm? What value are Nigerians adding in manufacturing? What values are Nigerians adding even in services? Because at the end of the day, if the values are added by Indians, the money ultimately goes to India. GDP is value added. If the value is added by Chinese, it goes to China. If it's added by Europeans, it goes to Europe. If it's added by Americans, it goes to America. Only the value added by Nigerians stay in Nigeria. And it doesn't really matter if that capacity to add value, if you add the value on Nigerian soil or anywhere in the world, it comes to Nigeria. So we should look at national. That's where the human assets comes in. What's the capacity of Nigerians, even what added on Nigerians, who owns the improved seedlings, who owns the technology, who makes, the tractors that we use and the rest of it. So don't begin to list sectors, begin to say how much are we ensuring that we upskill our human capital? How much are we ensuring that our cities is a choice place for others to come and try and, produce. The subsidy is a political debate, and it's not an economic issue. There is no right or wrong answer about it. The United States has written checks, maybe totaling about $5 trillion over the last 2 years to mitigate the ripples of the pandemic. 5 trillion is 25% of America's GDP. That's huge to inject that much in 2 years as subsidies, outright cash subsidy. But the American Congress considers that to be in the best interest of America. So the decision to maintain subsidy or to remove it is a political decision. It's not a matter of right or wrong. And for the fuel subsidy in Nigeria, you cannot separate the question of subsidy from the question of unstable exchange rate. If you didn't have the devaluation, a new subsidy won't emerge. You can't separate it from the fact that we import refined products. So if our refineries worked, then you don't have to import refined products. We produce the crude. So you can't take the subsidy and say government should remove it and ignore the fact that, okay, why can't government ensure that the refineries do work? Why can't government ensure that the exchange rate is stable? So, because if you remove it now and there's a devaluation 6 months or 1 year down the road, a fresh debate will emerge. So let's, put that in context. It's not something that you can, otherwise you just be overheating the system, unnecessarily.
Okay, thank you very much for that, Dr. Teriba. I'll move quickly to Mr. Kabweze, and I think I'll just ask the two questions together so you can respond to them. One is regarding how do we monitor remittances from NNPC, especially in the determination and removal of subsidy. It's nice to get your thoughts on that subsidy question as a government man as well. And then the other question I would like you to help respond to is that it's a question about excessive debt is a drag on future growth, especially borrowing for recurrent expenditure. And are the successive finance acts a boon or a drag on private entrepreneurship, innovation, and growth? So I think the question is both because there's a debt and that's what kind of drag is that on our future growth? And that's how do we see all the successive finance acts? We've had 3 acts now, whether they're a boon or a drag on private entrepreneurship, innovation, and growth. So over to you, Mr. Kabweze. You're muted. Thank you.
Thank you, Ike. I'm struggling to say Ms. James, but
I'm struggling to say Pastor Ben.
But all right, the questions: how do we monitor remittances from NNPC? I'm not quite sure what that person means, but there is a monthly meeting, the Federal Account Allocation Committee meeting, where the Ministry of Finance, sitting with the commissioners of finance and accountants general from across all the 36 states and the representative of the FCT, sit down and take an accounting from all the key revenue generating agencies. And you've had cases where they push back, they reject what, for instance, NNPC is submitting, and sometimes there's a stalemate for days at the fact. So that's basically it. There's an accounting to the federation. NNPC is an agent of the federation, not of the federal government. It's an agent of the federation for collecting and accounting for those revenues. So that's the first platform for monitoring that. The question of borrowing for recurrent expenditure. I think, as a broad principle, okay, capital expenditure is generally considered growth enabling, and therefore you should borrow for, for it. But I think people need to be, people need to understand here when it comes to public finance management, it's not that cut and dry. It's not a case of all capital expenditure is good and all recurrent expenditure is bad. Absolutely not. First of all, our public finance management laws, as well as global best practice, allows you to borrow for recurrent spending, depending on what it is. And especially recurrent spending on human development, principally on health and education. Expenditure on health and education tends to be mostly recurrent. But expenditure on health care, actually, there are studies, empirical measurements that show that they deliver a higher return on investment to the economy than even some investment in what is called hard infrastructure. And depending on what that infrastructure is, sometimes you can have a bridge to nowhere. It's infrastructure. But does that really deliver? So that I think we need to interrogate, what debt is spent on more rigorously than simply a broad, is it on capital expenditure or is it on recurrent expenditure? If you build bogus offices, that shows up as capital expenditure. What does that do for development? So that interrogation needs to be more rigorous. Are the Finance Acts, have they been a boon or drag? Let me say something about these Finance Acts. And you see, this is part of the challenge. I'm at heart a private sector, and to date, I have still spent a larger portion of my career in the private sector. Okay, so I understand the private sector, but I think that I struggle with private sector. There is still, and I'd say this is every sense of responsibility. There is still, a rent attitude and every whatever, and a holier than thou approach when engaging with the public. First of all, these Finance Acts, and I think Taiwo Idolo is here, so he might as well own up. These Finance Acts, the key crafters, the key contributors to it, people who have played significant roles in it, are members of the Tax Reform Committee who are drawn mostly from the private sector, including Taiwo Idolo and others. So I think that the bits there that, basically balances both perspectives. But I think that when it comes up like this, I expect even the private sector people who've been part of this to own up and, to whatever, and stand up and defend this. A lot of the discussion we're having today is about the budget. And I think people confuse the budget with economic policy. The budget doesn't make policy. The budget is made in the context of system policy, whether it is, fiscal, monetary, or trade. So if you wait for the budget to start trying to make your input, you're too late. It's too late. By then, the budget is made in context. By the time the budget is passed in December, the budgeting exercise starts in March. In another 2 months, the budget process for 2023 will begin. So it's in the process of formulating fiscal, monetary, and trade policies. That's where the private sector, that's where we should show up and make our contribution. If you're waiting for the budget to now comment, it's too late. So CBN Form M, whatever, had no bearing on budget, but of course, affects, the business environment. We should be engaging and pushing back through whatever, not waiting for the budget. Let me conclude by, quoting Ayo Tereba. He says, we elected the people, okay, the people in power, and they can't ignore what we say. Very apt. The question is, what are we saying? Who is saying? Take the petrol subsidy debate. My friend Taiwo was bemoaning earlier on. I feel just as I mentioned that this means now, and you're going to hear it because we're going to National Assembly. We're going to be asking to borrow 1 trillion naira more in consequence of this. while the debate raged, I didn't hear the IOD weigh in on this debate. Labor dominated the space, other CSOs dominated the space. The private sector, the players represented here, employed the bulk of whatever. Everybody sat down silent. Unfortunately, in such situations, it's not golden. And so today we've got, this is what we have. So we must, take a more active interest. And someone said, when will the budget office invite? Our doors are always open to take suggestions. We're not waiting. We have a citizens portal on the budget office website. 365 days a year, you can engage on it and send us whatever this there. We organize periodic, whatever this is, whether it's a public consultative forum on the medium-term expenditure framework and strategy, fiscal strategy paper. But these are periodic interventions. And even at that, we don't see most of the people here showing up to make contribution. But so I just like to challenge us. We all have a country, we all have a stake. We all have a stake in building this thing. Ayo Salami talked about this 710 billion naira. For 2 years, I was battling to get it, whatever, until the politicians shoved it off. We were pushing to sell down our stake in the JV. Eventually, after putting it in the budget for 2 years, and we lost the policy debate, we took it off, and that debate still hasn't been won. Let the private sector engage. You are stakeholders, critical stakeholders in this thing here. Engage the policy makers, engage the lawmakers. Don't wait for the budget to come out, which is made in the context of policies that are given, and be bemoaning.
Thank you. Thank you very much.
So one last comment. Privatization often gets a bad rap in Nigeria because we have a few failed cases. But I am one of those persuaded that on the balance, privatization has been positive. A lot of people forget that they only cite the ones that failed. They forget that privatization saved the banking sector in this country. Banks like S-Bank, UBA, Union, which are all large employers. I don't know what will have become of them by by now. Many of the hotels and whatever is there that they've been people forget that LMA Petrochemicals was dead for years. Today it's a major employer, major taxpayer. Notorious, the fertilizer plant in Port Harcourt was what was it? So. If but for regulation and privatization, we will have no viable, domestic airline sector today. So the fact that some have failed and everybody just, keeps sounding like privatization is some failed program.
Thank you very much, Mr. Kabrizi. A lot of food for thought there, and we take notes in terms of role of private sector to be more active in terms of when these policies are being made. So thank you for that. We'll move on to Taiwo Oyedele, and there was a question I asked earlier on, so please take note of that. I would put a second question, tag it along so that you can respond to the two. The other question was impact of all these additional taxes in Finance Act 2021 on the tax to GDP ratio. What are your thoughts on that? And then there's this question about considering the more informal structure of our economy and also coupled with the generally acknowledged inefficient tax collection structure by government, will it not be a better strategy to tilt our tax income to be more from consumption rather than direct taxes, should be more consumption-based rather than direct taxes like CIT and PAYE, which is putting more burden and strain on the productive capacity. So it's more of shifting taxes towards the indirect tax element as opposed to the direct CIT and PAYE taxes. So over to you, Taiwo.
Thank you, Nika. So I think I'll start first by briefly responding to the point raised by Pastor Ben. So I think, he's right. I'm a member of the Fiscal Policy Reform Committee that work on the Finance Act with a good number of private sector representatives. So on that basis, I would give the credit to government by being more engaging. Sadly, the issues we are complaining about now in this Finance Act, about 90% of them were introduced at the last minute by the lawmakers. They were not in the draft that we debated extensively with engagement with. So, you know, it's one thing to allow people to come and talk, right? It's another thing is whether you ignore them and do your things. And I'll tell you, excise tax on non-alcoholic beverages was not in the version that the committee worked on, that the president, the executive sent to the National Assembly. Taxation of educational institution was not there, so they introduced it overnight. Tertiary education tax increase from 2 to 2.5% was not in the work that we did. The lawmakers introduced it. NASENI, we had actually proposed, if you look at it, if you go and Google the draft bill now, we proposed for that to be taken off the private sector. They restored it back. The CGT on shares was to address an abuse that the FRS observed by private sector who want to sell assets are liable to CGT, but they put in a vehicle, sell the shares, and they evade, you know, paying the taxes. So the threshold from the committee was 500 million naira. The rate was 5%, was targeting private sector. The lawmakers decided to make it convoluted and they reduced the threshold and increased the rate. So I'm not going to deny that I'm part of the committee, but I think the broader conversation is we're going to look at government as a whole, not separating the executive from the legislator. We need to look at what we do as Project Nigeria. So nobody is more Nigerian than the other person. Because you're a lawmaker today does not mean that you have more entitlement to the country than I do. So if I have a superior argument, listen to me. If your argument is superior, then I'll listen to you. I think with that spirit, we'll start getting the right result for our country. So that's the reason I'll continue to complain, you know, even though I'm a member of the committee. But beyond the complaining, and I like the point that, you know, Mr. Kabweze made, let's also contribute, including the IOD. So to your question, I think that, you know, these amendments to the tax law would not move the needle significantly. My estimation is at best, we're going to increase tax to GDP ratio by 0.5%. And I say that because my estimation of the revenue from police levy is like 1 billion naira. That's the most disappointing of the amendment. From education tax going up by 0.5%, that's about 60 billion naira that you get from it. CGT on shares, you'll be lucky to get 20 billion naira. NASENI, you know, maybe somewhere around 10, 15, you know, billion. Now, where am I getting these numbers I'm throwing around from? If you look at the data for 2020, which is the complete data that is available, 2021 is being finalized, the accessible profit of Nigerian companies was 13 trillion naira. The taxable profit on which we pay CIT was 5 trillion naira. You know, so you can use that number to just make some analysis and maybe, you know, increase it slightly for growth in the economy, but nothing, you know, out of this world. I think the most impactful reforms that government has made, interestingly, we're not even the ones to do with increasing rates or introducing new taxes. They were the reforms around asking FRS to be the sole tax agency for the federal government and the federation. That is significant. Allowing the FRS to use technology to connect with taxpayers so that people who manipulate their, you know, their records, we can deal with that. That is significant. I expect those over time, it will not be immediate to yield the result that we're looking for. So the question around, you know, should we focus a little bit more on consumption and then less on, you know, on direct taxes? I don't think it's a binary choice. I think it's a choice that says, you know, who bears the incidence of tax ultimately? And is that what we intend? You know, there's this theory of the Cobra effect, you know, the theory of unintended consequences. So for every tax, ultimately, a human being bears the consequences, right? So whether it is direct, whether it's indirect, we need to think about who bears the burden. And that's where we want is that where we want the burden to be placed? If the answer is no, like we should try and limit the burden on SMEs, vulnerable households. And I do think that the middle class and the elite need to pay a little bit more. In many countries, including in Africa, like South Africa, if you're a top earner, you can pay more than 40% of personal income tax. In Nigeria, I can earn 1 billion per day and not pay up to 20%. So that's why I made the point about structural tax inequity. We need to address it. And then we can begin to also focus on how government utilizes the revenue after it's been collected. Thank you.
Okay, thank you very much. And thank you for those statistics in terms of impact of those new taxes on tax to GDP. I was actually looking for, your informal view, but you made it detailed and you made it empirical. So thank you very much for that. So I will move on to the next panelist, Mr. Awoyemi, and I'll be asking you a little slightly different question set. And just to make it, I can see our time is spent. So to quickly ask you that, given some of the principles underlining the project and the budget, it is expected that projected inflation is going to fall, while nominal consumption is expected to increase like some 25% between 2020 to 2022. So some growth in that regard. So the question here is that, are there ways to increase our local supply such that this increase in consumption does not leak all the way to foreign economies? And that if there are ways, what kind of investment do businesses need to position themselves so that they can benefit from this projected increase in consumption? So this is really speaking to our businesses in terms of where should they position themselves, that as inflation is reducing and consumption is rising, so that they can take advantage of that to grow their business. So help us, and maybe to just tag on that, earlier on it was talked about the sweetened tax, sugar tax, or rather tax on sweetened beverages. And you can also help us in terms of what are your views. I know a few views have been expressed earlier on, but what do you think the views are in terms of the impact of this tax on our businesses? We have heard about consumers, but what about on businesses themselves? So thank you very much to share your views, Mr. Awoyemi.
Very quick responses because of time. I also have the hard stuff. One is that the taxes, the answers were provided by Taiwo already. What you normally see happen, for example, while I was living in UK, what you tax things like cigarettes, alcoholic beverages. What you do therefore is that because of the pressure of the cost of the health services from those consumptions, they then tax you so that the increase in those taxes they use to meet the increasing demand on the health services which they use. There is a linkage between why the taxes are being done, where they're coming from, and what they are meant to serve. But we don't have that economy as well. And so one of the challenges from what Taiwo said and concerning these taxes is that there's a difference between adoption and adaptation. We simply adopt policies who operate on different economies than our own economy. So as regards this, our own economy, what you find out that it's almost inelastic. People will still buy those things they want to do. And I'm sure those who did those things must have taken the pulse of the market and realized that Nigerians seem to confuse. If you're happy, you drink. If you're sad, you drink. If nothing is happening, you drink. Also say we thank God that nothing has happened to us. And I'm sure it is that same kind of mindset devoid of data that has informed those decision making. What will happen to the companies in the short term is that they may not be immediately able to pass it on to consumers, so it will impact their profit. But over time, they will slip it in and pass it on to the consumer, which therefore addresses your second question about how we create inflationary pressures on the economy on its own. And that was what I was trying to draw about by policy intent and then policy outcomes. Because the lack of linkage between these policies, that one person looks at it from one side of his house and believes this is the best thing, and another person looks at it, and then they pass different policies, and never in a point in time have we had a situation. At the NASBA, where the organized private sector sits with the legislature, it would be interesting also that Mr. Kabwese should also drop in there once in a while and understand the frustrations that the private sector also have in engaging with government. We almost as if we treat it as if us and them. And that is a very, very difficult position you find ourselves. Every time I listen to him, you gain perspective. I also understand his own frustrations as well in getting things on. But the general thing we all must recognize is that if we have one country, you must decide from an ideological position that you want to grow this country through your private sector. You cannot do everything as a government. And if the private sector is telling you it cannot work, it's there. Now, having said that, there are also members of the private sector who are basically involved in untoward practices. And they give excuses that government is making things difficult. That's why they're doing so. Well, that is not fair on anybody. So the summary of it all is that there is not so much you can do concerning the inflation drivers. Some is policy driven, but it's also the absence of incentives as well. And as such, if you take a look at a country where the gentleman who was talking about the informal sector, where you have over 98% of your registered companies being in MSMEs categories, and then you look at the policies and you look at the drivers and the decision making out of the budget, you will find out that even this year's budget, you will not see the direct correlation of most of these things. The indices for MSMEs in the 220 budget are not really mainstreamed. The indices will appear to basically be implicitly captured in planned capital expenditures of MDAs, smuggled in there. So basically, we are running the country to fund the federal government, not even the federating unit. We talk about financialization, but we should also talk about fiscal subsidiarity as well. The challenges are many, but my summary of it all is that can we get to a position whereby we recognize that things are not working? And then we're basically kicking the can down the line. Those who are in government today will leave, they will come out and join us, and then they will also understand the challenges we face. Thank you very much.
Okay, thank you very much, Mr. Williami, for that. Thank you so much. So I'll move on to the last panelist, Mr. Ayo Salami. And I would ask you a question and then tag on something else along with it. The question is about, it's a comment and a question. Somebody asked that it will be interesting to know how long before VAT goes up in line with other countries. You did talk about earlier on about our VAT rate, and that is this sustainable? So I think really it's essentially to give us your views in terms of, do you think there's going to be further growth in VAT, or now that we have 7.5, government will maintain it in that? As a private sector person, it would be nice to get your views on that. Then the second question I'll put on top of that is that we talked a lot about the, well, NNPC, national assets there, but there are also companies operating in that sector. And given your background in oil and gas, we know that in the Finance Act, there was the removal of exemption from corporate tax for companies that are operating in the upstream, midstream, downstream petroleum operations. So what do you think in terms of the impact this removal would have on further investment in this still critical sector of the economy? So over to you, Mr. Salami.
Yeah, thank you very much, Nike. Let me quickly attend to the questions. The first one with respect to the VAT at 7.5%. Like I did say, if you look at the trajectory right from 2018, when I did the analysis, you see a consistent increase in VAT collection by the government. Now, why this is important is that in 2020, the rate was increased to 7.5%. And in that year, I think the collection jumped by almost 80%. In 2021, the collection more than doubled from 170 billion to about 360 billion without any increment in rates. So the point to that was that even though we admit that across Africa, Nigeria has the lowest VAT rate, despite that, and the impact of the pandemic, yet government was able to more than double VAT collection in a year. So the point of all of this is that if there's any avenue for government to increase its revenue, internally generated revenue, then VAT would potentially be the way to go. However, if you look at the way Nigeria operates the VAT system, it is still a cause for concern in the sense that technically it is operated like a sales tax regime, where practically almost the valid input VAT incurred by the sector that generates most of these VAT items are not recoverable. So it's a bit of a challenge in the sense that ordinarily it should be recoverable, and that may then also have an impact on collection. So if you ask me, what should government do, or how soon should they increase the rate? I would say, first of all, operate VAT regime in a manner and way it should be operated across the board. In a sense, how is it supposed to operate? The input-output mechanism must work, and there should not be any occasion where companies who validly incur input VAT are simply writing off against their P&L. So it is after you answer that question, I will do things practically to address that. I can then begin to think, oh, is it now high time to increase the rates? Is it high time to do something with the rates? So in a sense, manage the process, ensure that it works as it should work. Where companies have valid refunds, go through the process, refund them, and let people see that this is transparent and it works. Then you can really talk about increasing the rates, and that will also, in a sense, make sure that corporates who hitherto were had apathy in terms of compliance can also come out clean and do the work, because they know if they have valid inputs and refund, they will get it from the government. So that's the way I like to respond to that question. The second question on removal of exemption from CIT on PPT, i.e. companies who are in the upstream sector will now be required to pay either withholding tax. We don't tax on the dividends that they declare. I think that's the direction of that question. What this is all about is that previously, dividends declared out of petroleum profit, right, are exempt from withholding tax and CIT in a sense. Beneficiaries are not taxed on those dividends. But effective 2 years ago, that was changed. And then that means dividends declared by those companies with access to tax. Apart from that, then came the PIA, which introduced a dual tax regime for companies in that sector, in a sense, saying that it's going to be a kind of resource tax called hydrocarbon tax at either 15% or 30%, depending on the terrain you operate. And then in addition to that, a CIT at 30%. However, what you then notice is that even the aggregate of these two taxes are still, in a sense, less than the absolute tax rate that they pay today. For onshore, for instance, JV assets, you pay tax at 85%. For PSC, you pay tax at 50%. So in absolute terms, potentially, these companies may pay a lower tax at the end of the day, but ultimately, it may then depend on the terrain you operate in, and then the kind of assets that you have that will then determine whether it might be profitable or incentivizing to move on to the PIA regime or stay with the PPTA regime. So it's not a one-cap-fits-all. It's a question of what regime do you operate, what's the life cycle of your assets, and a host of other factors who can then determine as to the beneficial nature of converting to the PIA or not. So that's the way I would like to answer the question. I hope I address your question.
Thank you very much. I think that was quite insightful. So on that note, I would like to thank all our panelists and our keynote speaker for taking out time to answer these questions, and also to our participants for posting these questions, which has helped to improve the body of knowledge of everyone. And I do hope that with this discussion and the Q&A session, we have addressed the question of what will change in 2022 and what should our directors, business leaders, and professionals do about it. So on this note also, I would like to call on Mr. Dele Alimi to do us the honors of the vote of thanks and help bring to a close the webinar. So thank you, and over to you, Mr. Alimi.
Thank you very much, Nika. It's really been a wonderful session, quite revealing, and I kept monitoring the chat room, and at least to gauge the participants and see how we're doing. And I must confess, it's been a wonderful 2 hours and a few minutes. And I'm happy to note that the webinar had served its purpose, and the challenges thrown to Institute of Directors Nigeria has been noted. And I can assure you that we're going to respond positively to those challenges. Let me start by thanking our keynote speaker, Dr. Ayodele Teriba. We are not disappointed. I mean, we expected you to steer the honest, to be honest, and you did. And I'm glad that you were able to create the environment that led to the robust discussion that followed. It's a very big thank you to you. And like Oliver Twist, we always call on you, and we do hope that you will always be at our disposal. Thank you very, very much. And I would go next to our moderator. And I think the robustness of the discussion today, our ability to really strike the iron when it was hot, was because of the way she has handled this discourse. I want to say thank you very much to Yinka James of KPMG. We really, really appreciate you. And it's been wonderful having you here. And then, of course, to our panelists, I know how busy all of you are. And I want to start by thanking Mr. Ben Akabweze. It is refreshing to also listen to the other side. And it's good to have someone like you who has been on the two sides. It gives a broader perspective. And I assure you, the challenge thrown to the Institute is noted, and we are really going to take it, and we're really going to do something positive about it. Mr. Taiwo Oyedele, thank you very much. It was great having you here again. And the perspective you have given here has been quite enlightening. And I'm sure the audience also join me to say a big thank you to you. Mr. Awoyemi, our own Mr. Awoyemi, we thank you very much. You have really represented the voice of the core private sector in telling us what exactly to expect and what we really should do and what government should do to support the private sector. And of course, Mr. Salami, also somebody we call on at any time to do justice when it comes to the financial act and also the tax situation in the country. I say very big thank you to you too. It was really wonderful having you here and quite refreshing to know that it's not all a bad story. It's not all about challenges. There are also areas that we should give kudos to government and take good advantage of the opportunities given. And let me also say a very big thank you to the chairman and the president and the chairman of the Governing Council of the Institute. We basically say we planned this together, and I'm happy that it went very well, and we chose the right people, and their contribution has been appreciated by everybody. Madam President, I say a very big thank you to you. And also for people who have worked behind the scene. We have a committee that is called the Research and Advocacy Committee, led by Professor Nat Before. I also want to render my appreciation. Also, a very big thank you to you all, and of course to my colleagues in the Institute who have also worked tirelessly to make sure this happens. We say a very big thank you. This is our first webinar in our normal webinar series in IoT Nigeria this year, and I can promise everyone. And of course, to the participants, I want to say a very big thank you to you for staying with us for close to 2 hours and a half now. I thank you for participating, and I look forward again to having you join us at our next webinar. The Institute will be taking a look at the PIA. That is another very, very topical issue. We'll be taking a look at the PIA next. In fact, it becomes more topical with the issue we just discussed now, the suspension of the removal of subsidy and its effect on the PIA. We'll be talking about that in the next 1 week or thereabouts, and I also invite you all. So, distinguished ladies and gentlemen, I want to join the President and the Chairman of Council to say thank you to you all and to wish you a very wonderful day. Thank you very much.
Thank you very much.
Thank you. Have a
Thank
wonderful
you.
day. Everybody.
Have a good day. Bye-bye.
Bye, everyone. Thank you very much. Bye.
Thank you, everyone. Bye.